Hi everyone, I'm Basil Nilamra, tutor for financial reporting at Kaplan School of Accountancy and Management, a platinum approved learning provider. In this video, I'm going to discuss financial reporting pre-December 2024 mock exam section A debrief videos. So let's start with the first question. Indicate by clicking on the relevant boxes whether the following statement describing advantage and disadvantage of IFRS accounting standards are correct or incorrect. The first one, IFRS accounting standards improve comparability because they must be used by all companies. It is incorrect. IFRS is not required to be used by all listed companies in the worldwide. IFRS is not a mandatory or obligatory standard. Each and every country will have their own accounting standards, which as per that country's local rules and regulations will have to be followed. IFRS is not required to be followed by all the listed companies in the world. It is incorrect. IFRS accounting standards facilitate cross-border investment. That is true. If you have read FR Study Hub, one of the advantage of IFRS accounting standard, it facilitates cross-border investment because there is only one accounting standard in the worldwide which is used by everyone. So anyone in any part of the world, if accounting is done using IFRS, they will easily understand the accounting standards and as well as the accounting. So they will be able to, it will facilitate the cross-border investment. Third statement, IFRS accounting standards are suitable for reporting entities of any size and type. That is incorrect. IFRS accounting standards are more suitable for large companies with profit motive. It's not that suitable for small companies and non-profit organization. So it's wrong. It is suitable normally for listed company and profit organization, not for any size and type. IFRS accounting standard may be costly to implement. That is true because shifting from local GAAP to IFRS is costly. The entire accounts will have to be converted into IFRS and IAS. For that, they will require to train employees in IAS or IFRS or appoint employees who have knowledge in IAS and IFRS, which will be costly. So the first statement and third statement are incorrect, and second and fourth statement are correct. The next second question, IASB follows a standard setting process when developing a new standard. What is the correct order of the standard setting process? Arrange the tokens below in the order from step number 1 to 4, step 1, 2, 3, 4. So tokens are conduct a post-implementation review, issue a discussion paper if relevant, issue an exposure draft, and consultation with IFRS Advisory Council about the topic to the IAS work plan. So the first one is consulting with IFRS Advisory Council about the topic. That is step number 1. Step number 2 will be issuing a discussion paper if relevant. Step number 3 will be issue an exposure draft. And the last step, step number 4, conduct a post-implementation review. You'll have to drag and drop this in step 1, 2, 3, 4. So one is consulting with IFRS Advisory Council. Second one is issuing a discussion paper. Third one is issuing an exposure draft. And fourth one is conduct a post-implementation review. A similar kind of question is there in ACCA Study Hub. Third one, which two of the following criteria must be met for an asset to be recognized in financial statement according to conceptual framework for financial reporting? Recognition of an asset provide verifiable information. A recognition of asset provide relevant information. Cost of asset is capable of reliable measurement. A recognition of asset provide users with a faithful representation of the asset. It is probable that asset will generate future economic benefit. In conceptual framework, we have learned to record an element. Element can be asset, liability, equity, expense, and income. To record an element, three conditions must be satisfied. Condition number one, it must provide relevant information. Condition number two, it must provide faithful representation. And condition number three, it should meet the definition of the element asset, liability, equity, expense, or income. So the two condition to recognize asset as per conceptual framework is the recognition of asset provide relevant information and recognition of asset provide users with faithful representation. Now, some students might have written it is probable that asset will generate future economic benefit and cost can be measured reliably. What you missed is the cost can be measured reliably, and it is probable that asset will generate future economic benefit is correct, but as per accounting standard. The question is asking as per conceptual framework. If you have learned accounting standard 16 property, plant and equipment, if you have learned accounting standard 38 intangible asset, if you have learned accounting standard 40 investment property, if you have learned IFRS 16 lease, these four standards which deals with asset says that as per the accounting standards to record an asset, two criteria must be satisfied. And what are the two criteria that is have to be satisfied as per accounting standard? Criteria number one, it is probable that the asset will generate future economic benefit. Criteria number two, cost can be reliably measured. Now remember, these two criteria are as per accounting standards. FR students are advised to read the question very carefully. The question very clearly says that as per the conceptual framework. So as per the conceptual framework, we have learned to record an asset or any element, liability, equity, expense, or income. It should provide relevant information and faithful representation. So the answer is option 2 and option 4. A similar kind of question is there in ACCA Study Hub Quiz and Practice platform. Question number 4. Greek company, a company with a 31st December financial year end, decided to sell one of its building. So it's a clue. They have decided to sell a building. So that is IFRS 5 is applicable. On October X8, so the decision to sell was made on October X8. We have learned that once an asset is desired to be sell, that is hold for sale or held for sale, then from that date onwards, no depreciation. A potential buyer has been found to purchase the building in its current condition. Building is ready for immediate transfer to the buyer as soon as price negotiation are complete, and sale is expected to take place in early X9. The following information is relevant to the building at 31st December X8, the year end. Carrying amount at October X8, the date on which the asset was desired to be sold, 500,000. Fair value at October X8, the date on which asset was desired to be sold, 525,000. Fair value at 31st December X8, the reporting date, that is year end, 505,000. And cost to sell, $70,000. At what amount should the building be measured in Greek statement of financial position at 31st December X8? Read the question very carefully. They're asking how will you show this asset held for sale at year end in SOFP 31st December X8. So we have learned that an asset held for sale has to be recorded in SOFP at lower of carrying amount and fair value less cost of disposal. So at which dates fair value you have to consider? The question is very clearly asking 31st December 20x8. So you have to find out the carrying amount as on 31st December 20x8 and fair value less cost of disposal as on 31st December x8. So how much is the carrying amount? The question has given carrying amount as on October exit is 500,000. So carrying amount as on 1st October X8 is given. It is 500,000. But what we need is carrying amount as on 31st December X8. So normally the difference between two carrying amount is basically less depreciation. But IFRS 5 very clearly states that once an asset is held for sale, from that date onwards, asset will not be depreciated. So on October exit, the directors have decided to sell the building. So it became a held for sale on October exit. So from that date onwards, no depreciation. Meaning whatever is the carrying amount as on 1st October exit, it will be same in 31st December exit since there is no depreciation. So the carrying amount on 31st December exit will be 500,000. Now, fair value less cost of disposal. They have given two fair value. One at October exit, the date on which asset was held for decided to be sold, and fair value at 31st December exit. Which fair value you have to take? The question is asking what is the value of asset as on 31st December exit in SOFP. So you have to take the value as on 31st December exit. The fair value as on 31st December exit is 505,000 minus cost to sell 70,000. So that is basically 505,000 minus 70,000. That is 435,000. So which is lower? Carrying amount 500 or fair value less cost of disposal. Fair value less cost of disposal is lower. So as per IFRS 5, non-current asset held for sale will be recorded at 435,000. Now remember, if fair value is lower, there's an impairment loss as well to be shown in profit and loss account. So the impairment loss to be shown in profit and loss account will be the difference between 500 and 435,000, which is $65,000. They have not asked it. I simply told it for your understanding purpose. So here in SOFP, it will be shown at lower of carrying amount 500 or fair value less cost of disposal 435,000. So 435,000 is lower. So the asset will be recorded at 435,000. So moving forward to the fifth question, indicate for each of the items listed below whether expenditure should be included in cost of inventory or recognized in profit and loss in accordance with IAS2 inventory. And allocation of fixed production overhead based on normal capacity. So will you include production overhead in cost of inventory? Answer is yes. Inventory includes cost of raw material, cost of conversion cost, that is labor cost, plus production overhead, any cost incurred in factory premises. So definitely, yes, fixed production overhead will be included. And there is one more point in that fixed production overhead should be based on normal capacity. Yes, that is true. Fixed production overhead is based on normal capacity. So included in cost. Now, it was variable production overhead. It will also be included in cost, but it will be including in cost under actual capacity. Next one, abnormal amount of wasted material. No, it will not be included. It will be expensed off in P&L. Cost of storage after completion of inventory and before sale. No, it is not included in cost. It is recognized in profit and loss account. IAS2 very clearly says that the following items will not be included in cost. And what are the items that is not included in cost? One is abnormal wastage. It can be abnormal wastage of raw material or idle labor. It will not be included in cost. It will be expensed off in P&L. General administration overhead is not included in cost. It will be expensed off in P&L. And storage cost is not included in cost. It is expensed in P&L, very clearly stated in IAS2 inventory. Moving on to the sixth question. Tea company grows tea bushes on its tea plantation when the leaves from the bushes have reached maturity. They are picked and then dried using drying equipment. Select appropriate IFRS accounting standard that should be used to account for each of component of tea company's tea plantation by matching the correct token to correct component. Tea bushes, tea leaves at the time of picking, drying equipment, and they're asking which is the accounting standards to be followed. IAS 16, property, plant and equipment, IAS 2, inventories, and IAS 41, agriculture. The tea bushes will be recorded as per IAS 16, property, plant and equipment, because tea bushes are basically bearer plant. Bearer plant is treated as per IAS 16, property, plant and equipment. Tea leaves at the time of picking. Tea leaves is agriculture produce. Agriculture produce is dealt with IAS 41, agriculture. And the last one, drying equipment. It's an equipment, so it will be dealt with IAS 16, property, plant and equipment. So tea bushes, IAS 16, property, plant and equipment. Tea leaves, IAS 41, agriculture. And drying equipment, IAS 2, drying equipment, IAS 16, property, plant and equipment. So tea bushes and drying equipments, IAS 16 PPE, and tea leaves, IAS 41 agriculture. There's a similar kind of question in ACCA, Study Hub, quiz, as well as in practice exams. Question number 7. Teach company receives a 3 million loan from its local government to assist with expanding its business operation to build a private college. The loan has an interest rate of 1% and is repayable after 3 years. The prevailing market interest rate for similar loan is 6%. Select the correct answer to describe the nature of loan received and value of benefit received in accordance with IAS 20, accounting for government grant and disclosure of government assistance. The loan received from the local government is considered to be, select government assistance, government grant, 3 million, and 5% interest expense on the amount over 3 years. The loan received from local government is basically government grant, and the value of benefit received from government, it is basically what is the value of amount received from government. The loan given by government has an interest rate of 1%. So the loan given from government has an interest rate of 1%, and the prevailing market interest rate for similar loan is 6%. So government has given a reduced interest rate of 5%. Now that 5% interest expense on loan amount will be recognized over 3 years. Those who have attended my classes at Kaplan School of Accountancy and Management, Calicut branch and Cochin branch, as well as our live classes through Kaplan's eLearn or recorded classes through Kaplan's eLearn, I would advise the students to go through IAS 20 Government Grant My Tutor Note. In that tutor note, there is a loan from government, a point in my textbook. You can go through that and read this question. You will be able to understand. So the reduced interest have to be allocated over a period of 3 years. So moving to 8th question. Golden Company has purchased land for its mining operation. The purchase date was 1st August X8. Government legislation requires that Golden Company restores the land after a period of 5 years. On August X8, the cost to restore the land based on environmental expert advice is $180,000. An appropriate discount rate is 6%. Golden Company has a 31st December year end. Which of the following statement is correct according to IAS 37, provisions, contingent liabilities, and contingent asset? On August X8, what is August X8? The purchase date of the land. for mining operation. So that is initial recognition. So on August 6th, initial recognition, Golden Company should recognize a provision that is equal to present value of restoration cost and corresponding expense in P&L. Carrying amount of environmental provision at 31st December exit is 190,800. Option B, on August exit, Golden Company should recognize a provision equal to present value of restoration cost and a corresponding debit entry to land. The carrying amount of environmental provision at 31st December exit is 190,800. C, on August exit, Golden should recognize a provision equal to present value of restoration cost and a corresponding debit entry into land. The carrying amount of environmental provision at 31st December exit is 184,500. Option D. On August exit, Golden should recognize a provision equal to present value of restoration cost and a corresponding expense in P&L. Carrying amount of environmental provision is 184,500. Now, what is the treatment of provision? We have learned that there are various kinds of provision as per IAS 37. Let us discuss those provision a bit in detail. So this could become a kind of revision class as well for the students who are interested and willing to pass December 2024 exam. So there are various types of provision. One is provision for warranty. The second one is provision for legal case. The third one is provision for restructuring or redundancy provision. Restructuring or redundancy provision. And the fourth one is basically the provision related to site restoration or dismantling or landscaping, etc., with respect to mine, etc. Now, with respect to the first three, provision for warranty, provision for legal case, restructuring provision, all of these are basically provision. So provision is a liability. So the journal entry would be to credit provision. But what will you debit? An expense will be debited. Debit and expense in profit and loss account. In case of warranty, the journal entry is debit warranty expense in P&L and credit provision for warranty in SOFP. In case of legal case, it is debit legal expense or penalty or fine in P&L and credit provision for legal case. And that legal case provision include the fine penalty that is probable plus legal fees as well. In case of restructuring provision, also it is the same. Debit employee compensation expense in P&L and credit provision in SOFP. But in case of mine, in case of site restoration, in case of dismantling, in case of landscaping with respect to a mine, provision will be credited in SOFP because it is provision. But debit is not expense. Debit is asset. Debit is mine, or in this case, the asset is land. So debit land, credit provision. And it is also stated in Accounting Standard 16, property, plant, and equipment, an asset should be initially recognized at cost, and cost includes purchase price, add less trade discount, add non-refundable taxes, add import duty, add any expense to get the asset ready for use, which includes initial transportation cost, initial testing, handling charges, and present value of site restoration or dismantling or landscaping in case of a mine. So as per Accounting Standard 16 PP, also the present value of site restoration, dismantling or landscaping is initially recognized in cost. That means it should be debited to asset. So option A says that on August exit, that is the date of the purchase, initial recognition, it should be recognized a provision equal to present value. That is correct. And corresponding expense in profit and loss account. That is wrong. the corresponding expense is not shown in profit and loss account. The corresponding expense is actually show it's not an expense, it is debit land. So A is wrong. On August X8, Golden Company should recognize a provision equal to present value of restoration cost. Absolutely right. And a corresponding debit entry into land. Yes, absolutely right. The carrying amount of environmental provision at 31st December X8 is 190,800. Those who have attended my classes at Calicut branch of Kaplan School of Accountancy and Management, or Cochin branch of Kaplan School of Accountancy or Management, or live classes by Kaplan Zealand, or recorded classes by Kaplan Zealand, I have very clearly stated that it is one of the favorite topic of FR examiner. Do you know the impact of present value? Do you know how to calculate present value when future cash flows is given? Do you know how to calculate present value at a different date? Do you know unwinding of discount? Do you know how to calculate unwinding of discount? Do you know what to treat unwinding of discount? Is it an expense? Is it an income in profit and loss account? Do you know the treatment of consolidation deferred consideration? When to calculate present value? Where to calculate present value? Where to show the finance cost, time value of money, unwinding of discount? It is one of their favorite topic. So if you are interested in passing December 2024 exam, please listen very carefully. I'm going to discuss present value a bit in detail. This is very useful for my students who have attended my classes. I hope it will be useful for others as well. I'm not simply debriefing, I'm discussing IAS 37 in detail with respect to various topics that I've just stated, 8 or 9 topics I stated. I'm going to club into one thing and give you a pill that simply you take it and swallow it. And if it is going to be asked in December 2024 exam, it will be very useful for you and you will pass the exam. Once you pass the exam, if you find this class as useful, please let me know in the comment section it's useful. So it gives me motivation to present more and more videos in upcoming sessions. So now the most important thing is once present value is given, the present value as on August 20x8 is basically 180,000. Now, what the question is saying, at 31st December 20x8, the present value is 190,800. So how will you calculate the present value at 31st December x8? On 1st August x8, the present value is 180,000. What should be the present value at 31st December x8? You have to add unwinding of discount. You have to add inflation. You have to add time value of money between these 3 months of August, September, October, November, December, 5 months. And that time value of money or inflation is in accounting terms known as unwinding of discount. So unwinding of discount, how do you calculate unwinding of discount? It is present value multiplied by discount factor rate multiplied by time proportionment. And how much is the present value? Present value is 180,000 multiplied by discount factor rate. Discount factor rate is cost of capital or in percentage, 6%, multiplied by time value of money, 5/12. Multiplied by time proportionment, August, September, October, November, December, 5 months. Now let's use a calculator. Standard. So present value is 180,000 multiplied by 6% multiplied by 5/12. That is equal to 4,500. So unwinding of discount is $4,500. So the present value at 31st December x8 will be 180,000 plus 4,500, 184,500. So this value 190,800 is wrong. How they might have got this 190,800? They might have not time proportioned it. So if you take 180,000 multiplied by 6%, you get 10,800. So 180,000 plus 10,800, 190,800. Option B, it is a wrong answer. It's not time proportioned. I hope my students who have attended my classes at Kaplan School of Accountancy and Management, Calicut branch, and Cochin branch, as well as our online students who attended live classes at Kaplan Zealand and recorded classes at Kaplan Zealand, I have been reiterating that there will be some time proportionment in section A, section B, as well as section C. So always be careful with the time proportionment. So it's 184, 500. So this 190, 800 is wrong. So moving on to the option C, on August exit, Golden Company should recognize a provision equal to present value of restoration cost. That is correct. A corresponding debit entry to land, correct. Carrying amount of environmental provision at 31st December exit is 184, 500. That is the answer. Let's read option number D as well. On 1st August exit, Golden should recognize a provision equal to present value of restoration cost, which is correct, and corresponding expense in P&L. That is wrong. In case of a mine, the corresponding is given, debit is given in mine or asset, not P&L. So that is wrong. So option C is correct. On August exit, Golden Company should recognize a provision equal to present value of restoration cost and corresponding debit entry into land, and the carrying amount of provision is 184 500 at 31st December exit. Now the provision, now as I told you, I'll be discussing a bit in detail. Since provision is a liability, the unwinding of discount will be treated as finance cost in profit and loss account. Is finance cost. That will be shown in P&L as an expense. If this is related to an asset, then the unwinding of discount is shown as an income in profit and loss account. And it will be normally that income will be shown in operating expense or administration expense as a negative figure. Those students who have attended my classes at Calicut or Cochin branch of Kaplan School of Accountancy and Management, or the recorded class or online live classes at Kaplan's eLearn, I would advise you to go through the single entity question that we have done. And question number 1 in my tutor note, there is a question where there is a receivable unwinding of discount related to receivable and revenue. Since it was related to receivable and asset, income in P&L will be shown. I would advise the students of Calicut branch of Kaplan School of Accountancy and Management and Cochin branch of Kaplan School of Accountancy and Management and the Kaplan's eLearn live as well as recorded students to go through the question number 1 of my tutor textbook, single entity for this asset, unwinding of discount, income in P&L, operating expense and admin expense. Moving forward to the 9th question. In debt issued 20 million convertible loan note on 1st July X3. In 5 years' time, on 30 June X8, the holders can choose to redeem the loan note for cash of $20 million or convert them into fixed number of ordinary shares. At 1st July, the present value of loan note with similar term but without conversion option was 18.97. Which statement is correct in accordance with IAS 32, financial instrument presentation? So now moving forward to that particular aspect. So it's a convertible loan note. So as per IAS 32, we have learned that convertible loan note should be initially split into two, one into equity and second one into initial liability. And initial liability is basically present value of actual interest plus present value of principal repayment. Plus present value of principal repayment. Now, how to calculate present value of actual interest plus present value of principal repayment? You already knew that. If you read the question, they say that a 20 million convertible loan note was issued on July X3 And at July, that is the date on which it was issued, the present value of loan note with similar terms but without conversion was 18.97. So basically, they have given initial liability present value 18.97 million. And we have learned that equity is cash received minus initial liability. Initial liability. So how much is the cash received? 20 million minus initial liability, that is present value of actual interest and present value of principal repayment, 18.97 million. So the equity would be 1.03 million. This is how the 20 million have to be split into equity and initial liability. Now they're asking which is the correct in accordance with IAS 32. At July, in-depth company should recognize a liability of 18.97 million. That is right. At July X3, they have to initially recognize liability at present value of actual interest and principal repayment, which is 18.97 million. Second sentence, if the loan notes are converted on 30 June X8, 18.97 is transferred to equity from the liability. That is wrong. The equity amount is 1.03 million. And second one, at July X3, in-depth should recognize an equity balance of 1.3 million. This balance is subsequently increased to 20 million by 30 June X8. By 30 June X8, the amount will be 20 million. Seems to be right. Let's read the other options as well. At July X3, in-depth should recognize a liability of 18.97 million. That is correct. An initial liability should be recognized at present value of actual interest and principal repayment, which is 18.97 million. A finance cost of 1.03 million should be recognized. That is absolutely wrong. That 1.03 million is actually equity, not finance cost. So C, definitely not an answer. D, at July X3, in-depth should recognize an equity balance of 20 million. That is absolutely wrong. Equity balance we have just calculated, it is 1.03. So what will be the answer? Option B will be the answer. At July X3, in-depth should recognize an equity balance of 1.03 million. The balance is subsequently increased to 20 million by 30 June X8. You have to understand the question. It is by 30 June X8. So by 30 June X8, the liability would be 20 million. It's a slightly tricky question. So normally, we have learned that initial liability will be recognized at present value of actual interest plus present value of principal repayment. And you know how we show the SOFP? We have learned that we start with initial liability. Initial liability, that is 18.97 million. We'll be adding effective interest. And this is the effective interest that will be shown in P&L. We have to add it. Then we will deduct actual interest. Actual interest. Then you will get a closing figure that we have to show in SOFP. The next year will be this closing figure, that is opening. Current year closing will become next year opening. Then add effective interest less actual interest. Likewise, you have to move forward for 5 years. If you go for 5 years, like this amortized cost method, by the end, you will get this 20 million. Now, students will be asking, sir, can you show that they have not given effective interest? So those who have attended my classes at Capens can do that exercise. You take the initial liability, add effective interest, less actual interest, you will get an amount. And the next year, on that amount, effective interest, less actual interest. Next year, on that amount, effective interest, less actual interest. If you add like that, by the end of the third year or fifth year, whatever is the case, most of the questions we did was 3 year. At the end of the third year, you will get the same 20 million. So anyway, it's pretty much straightforward. The equity element is 1.03 million. Moving forward, question number 10. Parent company owns 35% of KIT, which gives it significant influence. So it's an associate company. During the current financial reporting period, parent company sold inventory to kid company for $8,000 at a margin of 30%. At the year end, inventory remained unsold. Parent company has recognized a receivable balance of 8,000 for the sale, and kid company has recognized a corresponding payable balance. This is between parent and associate. So the unrealized profit is 2,400, and receivable and payable balance are cancelled in the consolidated financial statement. So let's calculate the unrealized profit. Now I need everyone to listen very carefully. In case of parent and subsidiary, you have learned how to calculate unrealized profit. In case of parent company and subsidiary company, the unrealized profit is basically selling price of the closing inventory multiplied by profit. Depending upon margin or markup, the figures will change. But in case of parent and associate company, the URP is basically selling price multiplied by profit calculated same as subsidiary company margin or markup. But in case of parent and associate, there is one more item that URP will be multiplied with parent company percentage. Because we have learned that in associate company, only two things will be shown in consolidation. One, investment in associate as per equity method in SOFP, and second one, parent company percentage of post acquisition profit of associate company in group return earnings. So with respect to the profit, anything affecting profit of associate company, only parent company percentage is included. So in case of unrealized profit also, only parent company will be included in case of associate. So how much is the amount sold inventory to kid company for 8,000? So 8,000 is the inventory amount at a margin of 30%, so 2,400. But remember, this is parent and associate. We have to multiply with parent company percentage. So now using the calculator to find this out. So 8,000 is the closing inventory, selling price included, multiplied by 30% margin, 30 by 100, multiplied by parent company percentage, 35,840. So the option A, unrealized profit is 2,400. That is wrong. Unrealized profit is basically 840. Second one, unrealized profit is 840. That is correct. Receivable and payable balance are cancelled in consolidated financial statement. No, in case of associate company, intercompany transactions are not actually cancelled. In case of associate company, only two things will be included. One, in consolidated financial statement, one, investment in associate as per equity method in SOFP, and parent company percentage of post acquisition profit of associate in group return earnings. Intercompany receivable and payables are not cancelled. Option C, unrealized profit is 2,400. That is wrong. Option D, unrealized profit is 840. That is correct. And receivable and payable balances are not cancelled. That is correct. They are not cancelled in consolidated financial statement. So option D is the correct one. Fit company, question number 11. Fit company owns 40% shareholding in Dot company, which gives it significant influence. During the year, Fit company sold goods to Dot company. At the year end, Dot still holds some of these goods. Select the correct tokens to reflect consolidated adjustment required in relation to unrealized profit. So this question is transactions from Fit, the parent company, sold goods to Dot. So parent company is selling goods to Dot, that is associate. So we have learned that if parent is selling goods to associate, the entry would be debit, that's a downstream transaction, debit cost of sales, and credit investment in associate company. So debit cost of sales, drag and drop it here, and credit investment in associate company. Question number 12. Beaver Company has a year end of 31st December X6. It entered into following foreign currency transaction in the current year. Transaction 1, on 25th October, Beaver bought inventory denominated in foreign currency. At year end, inventory has been sold. However, supplier has not been paid. So there's a payable. Transaction 2. On 1st July 20XX, Beaver Company purchased equipment to be used in its operation, paying in a foreign currency. The equipment is measured using cost model and depreciated over useful life of 5 years. Indicate which of the options are correct in accordance with IAS 21 foreign currency. A trade payable is a monetary asset, a non-monetary asset. It's actually item. So a trade payable is a monetary item. Any amount receivable in foreign currency or any amount payable in foreign currency is monetary item. So they have to pay an amount in foreign currency because they have bought inventory and this amount has not been, supplier has not been paid. So there's a payable in foreign currency. So the payable is a monetary item. And IAS 21 says that the monetary item should be retranslated at closing rate in year end. So the trade payable is not retranslated at 31st December X6. Retranslated at 31st December X6 is the answer because at year end, monetary item will be retranslated at closing rate. The equipment. We have learned as per IAS 21, property, plant and equipment, intangible asset, and inventory are non-monetary item. So equipment is a non-monetary item. And how will you show that non-monetary item in SOFP? It is based on whether cost model or fair value model is followed. If cost model is followed, the asset will be shown in SOFP at rate on date of transaction, meaning it is not retranslated. And if it is fair value model, it will be recorded at rate on date of revaluation. So they are following equipment at a cost model. So the equipment is not retranslated 31st December X6. It is not retranslated. Since cost model, it will be recorded at rate on date of transaction. So there is no need to retranslate. Those who have attended my classes at Kaplan School of Accountancy and Management, Calicut branch or Cochin branch, or online live classes or recorded classes by Kaplan's eLearn, I would advise you to go through IAS 21, my tutor note. And we have done a question. The name of the question is Sunshine Company. And we have learned how to show property, plant, and equipment under cost model and under fair value model under that Sunshine question. So I would advise my students of Kaplan's to go through IAS 21, my tutor note. Question number, question name, Sunshine. You will get an idea about this cost model and fair value model if you have forgotten it. Question number 13. Freddie Company purchased a building, paying for it in a foreign currency. The building was classified as investment property and Freddie adopted IAS 40 fair value model for such investment property. Since the building was purchased, its fair value has increased and exchange gain has arisen. Which of the following option is correct in accordance with IAS 21 foreign currency transaction? Increase in fair value and exchange gain should be recognized in P&L. Straightforward, that's the answer. We have learned that investment property fair value gain should be recognized in profit and loss account. And we have learned in IAS 21, any foreign currency gain or loss should be recognized in P&L. So both will be recognized in P&L. Option A is the correct answer. Let's discuss B, C, and D. Increasing fair value and exchange gain should be recognized in other comprehensive income. That is wrong. increase in fair value of investment property has to be recognized in P&L, and foreign currency gain or loss will also be recognized in P&L, not in other comprehensive income. Option B is wrong. Option C, exchange gain should be recognized in profit and loss. That is absolutely right. Foreign currency gain or loss will be recognized in P&L. And it says fair value gain should be recognized in OCI. That is wrong. Investment property, fair value gain or loss should be recognized in profit and loss account. And why option D is not the answer? Let's read it. Fair value gain should be recognized in P&L. That is true. Exchange gain should be recognized in OCI. That is wrong. Fair value gain of investment property will be recognized in P&L. Foreign currency gain will also be recognized in P&L. So both will be recognized in P&L. Option A is the answer. Moving on to question number 14. Thirsty Company manufactures Quench branded soft drinks. The brand was purchased from a competitor during the current year. So they purchased a brand, so it can be recognized as an intangible asset. It's purchased. Thirsty management believes that Quench brand will contribute to net cash flows for the entity indefinitely. So it's an indefinite intangible asset. We have learned in accounting standard 38, there are two criteria, there are two things that you have to remember with respect to asset, intangible asset with indefinite life. One, it should not be amortized. Second, it should be tested annually for impairment. Now let's read the question. Which of the following requirement reflects correct accounting treatment for brand IAS 38 intangible asset? Amortize the brand over a maximum useful life of 10 years. That's wrong. The asset is having indefinite useful life, so it should not be amortized at all. Do not amortize the brand, but review useful life if there is evidence that it has changed, and test of impairment if indicator exists. That's wrong. Normally, other assets will have to be tested for impairment if there is indication. But an intangible asset with indefinite useful life should be tested for impairment annually. So B is also wrong. Amortized brand over maximum useful life of 10 years, that is wrong. As we have learned earlier, asset with indefinite life cannot be amortized. So the last one, do not amortize the brand, correct? And test for impairment annually, that is also correct. An intangible asset with indefinite useful life will not be amortized and it will be tested annually for impairment. Option D is the correct answer. Moving to the last question of section A, question number 15. The following information relate to profit company at 31st December X8. Equity shares of $2 200,000 X8 and 50,000 in X7. Profit for the year 160,000 in X8 and 95,000 in X7. During X8, there was a bonus issue of equity share. No other shares were issued in X7 or X8. Complete the sentence below by filling the blanks. In accordance with IAS 33 EPS, basic EPS in X7 presented as comparative in X8. What is comparative in X8? Corresponding figure. What is that? They're asking us to find out the restated EPS. We have learned that EPS should be restated in two situations. One, it should be restated when there is bonus issue, and second one, when there is rights issue. In case of bonus issue, the restated EPS is basically previous EPS into inverse of bonus factor. But those who have attended my classes would remember we have discussed in the classroom that restated EPS means what would be the EPS, what could have been the EPS if bonus issue or rights issue was done in previous year. So that is restated EPS. What would be the EPS if bonus issue was done in previous year? So if bonus issue was done in previous year, X7, the profit for the year is 95,000. It will not change. Divided by, in denominator, it will be number of shares including the bonus. What could be the EPS when bonus was issued in previous year? So if bonus issue was done in previous year, in exit, there is $200,000 worth of equity shares after bonus issue. So how much will be the number of shares? Share capital, that is 200,000 divided by nominal value 2. So including bonus, there is 100,000. During exit, there was a bonus issue of equity share. So this 200,000 is after bonus issue. So that is means 100,000 shares after bonus issue. So 95,000 divided by 100,000 shares is 0.95. So they're asking in cent. So $0.95 is the answer. So to convert into cent, we'll have to multiply with 100. That will be 95 cents.